So without further ado, let me welcome Jagdeep Bachher to the stage. Jagdeep, like I said, is the Chief Investment Officer at the University of California Investments. It's a $170 billion fund, though the market was down substantially today, so I decided not to ask him what that $170 billion is today. But he's got a really nice take.
Should I sit or stand?
You can. I'm going to sit in a minute. Sit.
I'll stand with you. It's good.
All right, and these copies of his book, the UC Investments Way, is sitting outside. If any of you are interested in it, some of you seem to have gotten it already. But with that, let's welcome Jagdeep to the stage. All right.
I thought this would relax us during the conversation.
All right.
Cheers.
I usually never drink during my own conferences.
But I made you do it tonight,
so
there you go. We'll have a cool conversation. I think the water can go away.
Maybe this is how we should all manage our money. Actually,
Maybe.
after what happened in the market today, we
2.5 points down, you need one of these.
Do you guys want me to get champagne from outside so you can sit down your sorrows? Feel free. All right, let's. And I think before that, you were at Alberta managing one of the sovereign funds for Canada. So you've got a long career in managing money in the public sector.
About 20 years in total since I left school. So now it feels long compared to all the young folks in the digital world.
Yeah. Right, and you know, Jagdeep's spoken at the World Economic Forum and the Goldman Sachs conferences and things like that. But so you know, we've had obviously conversations as we were getting ready for today, and he just has a really interesting perspective on this. So I want to start with, you know, given what I've been joking about, not joking about the stock market, but what is your take on today's global economy and of course the U.S. economy? How do you think about like what's going on with inflation, with strong U.S. dollar stock market doing what it's doing?
Thank you for having me, Vijay. Before I do that, though, would it be okay if I just gave our friends a little bit of the context of what the University of California Investment Office means? Because then a lot of these questions will sort of make sense.
Fantastic. Let's do that.
So I know you're all at UC Irvine, which is a fabulous campus. But when you think about the UC system, there are 10 campuses as wonderful as Irvine across the state of California. And we also have 3 national energy labs. We also have quite a large footprint of agriculture and natural resource communities and centers. And then, of course, we have a couple of hospitals, more than a couple of hospitals. There's one big one here at UC Irvine, and Scott is somewhere in the audience, who's our Chief Information Officer right there. But we also have 10 or so medical centers around the system. So if you think about us as a company at the University of California, we would have 300,000 employees, roughly speaking, and we would have 300,000 customers, students, that make up that number. If you think about us as a P&L, we would have about $40 to $43 billion P&L per year as an enterprise. And interestingly, off that, 23 is hospitals. So we're really a small university hidden within a large hospital. Is one way to look at the University of California. And so what I do with my team in Oakland is we manage the balance sheet for the university. And that's what amounts to, depending on the day, maybe it's down 2.5% today, but you know, between the 150, 160, 170 billion dollar. But those assets are for all the different customers and the stakeholders that I've described. So when you talk about what happens in the economy, I think I would just say, let me focus on the US economy for a moment. California, some would argue, is a country on its own. But in the context of the US economy, and we think about just our own backyards and our homes, of course, there is inflation, there's talk about a recession, and we've got a very strong US dollar at the moment, globally speaking. So there's a number of things going on here. What I would say, though, is we're probably the best neighborhood to be in around the world here in the United States, unequivocally. And I say this because I've actually taken sort of, when the world opened up in April, through almost last week, I've been in Europe 3 times, I've been in Asia once, and certainly different parts of the US. The US feels like it's humming on a variety of cylinders. And I think a lot of that is because even though there is talk about a recession and there's talk about nervousness globally, I think our companies, the companies that you're all part of and you're building and growing, still seem to be doing well in terms of earnings. What we have to deal with is a lot of cheap money that was candy for at least the last decade. And that cheap money is now becoming something people have to reckon with, because no matter which company you are or which university you are or which hospital you are, if in your stress scenarios of your business plans you didn't account for interest rates, short-term rates going from 0 to 5, sort of in a vertical line in this short a time period, you're going to have to figure out, what does that mean for you? What does it mean for your company? What does it mean for you personally on your balance sheet if you have one of those, second home mortgages out there, or a home equity line, which is very real. There's about $1 trillion worth of these home equity lines people have taken out because they bought a second property, they have a rental property, and with mortgage rates now resetting at about 6, 7, 8%, that starts to become painful. So when you hear about the Feds talking about pain, that's kind of the pain they're talking about. And when you talk about companies, the cost of debt is important. So very simply, if you own a building or a real estate asset, if your debt expenses are higher than your operating income, you've got a problem on your hands. You may have to hand your keys or figure out how to make money. So these are the types of challenges that we have to deal with here in the United States. I'm sure we'll get a chance to talk about the rest of the world. It's a little bit more complicated,
Right.
But there's a lot going on.
No, it's interesting that you said that, because one, I just read yesterday or today that jobs are still plentiful. Companies are still having trouble filling jobs, so there's a lot of open jobs. Then I read that the banks that lent Elon Musk money to buy Twitter are holding on to the debt because they can't find immediate takers for the debt, so they've decided to hold on till next year.
Right.
So all of this speaks to sort of how the environment for both tech stocks and for interest rates just completely changed in very short order.
But while jobs are plentiful, and even the report today was promising, all of you are leaders in companies and you're planning for the future. I think when earnings start to slow down and when growth slows down and you're looking at your top line revenues, either flat or slowing, and you have debt on your balance sheet, and you've got to balance these equations if you're a public company. I mean, gravity and math do work. It's sort of a simple thing, right? And so in that context, I think the 2 levers that the government has are interest rates, which even today are being exercised at the same rate that they've suggested they would. But the other lever is layoffs.
Yeah.
I think I've come to the conclusion, and it feels good when 25% of the S&P 500 are tech companies. And then you think, when people say to you, well, this is a risk, and you're like, it can't be a risk. But that's where gravity plays a role, right? Things do come down. $2 trillion can become $1 trillion in market cap. And I think in that context, layoffs is something, since this is a 2023 conference, we can pretend it's good in 2022.
There we go.
But you do need to think about more layoffs potentially happening in the economy in 2023 and 2024, because math has to balance itself out somehow.
Now, you 2 trillion to 1 trillion. I don't know what company you were thinking of, but I actually
Maybe all 5 of them.
But the Amazon literally
Except
went from 2 trillion to 1 trillion in the course of 6 to 9 months. I wasn't keeping track of exactly when, and I was thinking about that, because in some sense, what we're saying is the outlook for Amazon has changed so substantially in the last year, right? Because if you believe in rational markets, you believe that 2 trillion was, some proxy for a reasonable value for that company, all the way down to 1 trillion, which is, so there's shrinking demand for cloud services, which I think perhaps, that's what I read anyway, you guys can tell me if that's true or not, but there's some reduced demand for AWS, which is its most profitable division, and all the CapEx that they're incurring, and then interest rates. I guess.
But you also have the retail investor.
Yes.
And so sometimes the retail investor gets a little exuberant about how exciting things are. And I think in the last couple of years, we just all felt like we were going to live like this forever and work from home was the thing forever, and that we would always order everything off the computer. So I think some of that excitement got baked in quickly into market prices and things of that nature. Some of it is probably very well warranted because it reminded us that this was the new kind of digital infrastructure that beat being on roads. But having said that, I think, again, I just come back to math and gravity, right? Physics, and these things do play a role in even stock prices.
So let's move on, because like I alluded to in my opening remarks, there's been a lot of change in the in the business context, right? So we've got the pandemic, which is still in, sort of, at least, depending. Some people prefer not to call it that.
Right.
War in Ukraine, decoupling from China. The UK is in real trouble. Lots of regulation, the EU around digital, the planet under stress. When you, and I know you're a long-term investor because obviously you're taking a 100-year view, and the University of California will be here after all of us are long gone.
Definitely.
How do you sort of build a worldview amidst all of this volatility, or turbulence, as we've titled this session?
Well, one thing is, the world is complicated. I've been here for 8 years, and when I look at the world we live in today and the landscape, it seems that there are more things going on than there were 8 years ago or even 4 years ago. And so, in order to make sense of these things, I do think it is important to get away from your own home and your own country, to look at it from the perspective of how others are looking at you. So when you show up in Asia, it surprised me when the war started and I was in India in April. Whether it was professionally or personally, people said to me, this is really the Americans trying to fight with Russia. And it surprised me that this was the sentiment coming from people in India. And this was really a US-Russia war versus a Russia-Ukraine war. But if you go to Europe and you go to the Middle East and other parts of the world, I think there is a growing consensus against the West and the way the West has dominated and does things with the rest of the world. That's a perspective, I think. So you have to put yourself in other people's shoes to see how are they seeing us and what is our worldview and their worldview. It may not be the same. So that's one thing to keep at the back of your mind. The other thing is, I think geopolitics has had an impact on financial markets for quite a while. But if you go back to 2008, we had a financial crisis here in the United States. But you might recall what happened was our banking system and excesses and greediness in our financial players led to basically a breakdown in the balance sheets of a lot of financial actors. Well, keep in mind, China, Korea, and other countries actually came and provided balance sheet capital to bail out American financial institutions. That happened in 2008. And it happened openly and it happened freely. And the phone lines were on 24/7 between leaders of countries trying to navigate a global financial crisis. In 2021, the Chinese do not want to use vaccines coming from the United States. I think that's a different landscape that we're talking about. And could that mean that globalization peaked in some way in 2008 and has then been on a decline to the point that the pandemic has shown us these fractures and individualization of countries? So I think that sentiment of what is going on around the world in terms of protectionism, it may have started with certain political parties or certain political figures in different parts of the world. And maybe it was Brexit in 2016 that ignited this type of a sort of sentiment. But the reality is there is a lot going on geopolitically that is playing out in the financial markets. In my view, the one big thing that is playing out geopolitically is there was a decoupling between the United States and China. If we forgot about the rest of the world for a brief moment, which is unfair, but if there were two countries, the US and the China, there is an explicit decoupling that is taking place. And it hasn't gotten better in the last 2 years with a change in the political landscape. So with that decoupling, what I discovered in the last 3 months and being in Europe, for instance, is this is no longer just the US and China. I think the Europeans are actually starting to say, we're going to start to be more careful about our trading partners and our trading relationships. And what surprised me the most was 2.5 weeks ago, the Deputy Prime Minister of Canada, which is, I'm Canadian, it's inconsequential in the global political stage, also said, we're going to figure out different partners to trade with. So this decoupling that is taking place between the United States and China is certainly a very important fracture that needs to be watched carefully. So that's going on. Different people have different perspectives on what's going on. I think Europe, without a question, is more fragmented and disjointed and disorganized as it relates to dealing with either the pandemic or the financial crisis. The Middle East has clearly decided to send a message back to the United States with what they're doing in terms of oil, and they're obviously profiting financially from the commodity prices at the moment. So you look at all of these factors, and I think you have to basically say, where do I play as an investor? Mm-hmm. And what does that mean for us? Well, we can talk a little bit more about, but I'll tell you some things it clearly means. One, I've asked our team to bring back $4 billion from China. Why? I can't even go to China to actually do any due diligence to visit anything. I mean, if I can't even visit somebody that I'm going to invest with or be invested with or be quarantined for a long time, I don't need to keep $4 billion down there. I did not have that view. And most investors didn't have that view over the last 10 years, because they thought that China was the second largest economy and it was much bigger in weight than the stock market index was giving it value for. Therefore, they always had to be overweight China. And therefore, everybody was overweight China in investing. If you look as of the 27th of October of 2022, if you had put $100 in China 30 years ago, your return would have been zero after 30 years. This is a fact. The MSCI China has produced a 0% return in the stock market for $100 invested 30 years ago as a long-term investor.
Interesting.
The best performing market in the world, can you all guess which country that might be? If you put money 30 years ago in that country versus China, where would you have had your best return? Country one, country two. I work with you, so you can't tell me. Well, let's take a guess.
He's trying to answer your question?
Yeah. Sorry. USA, fabulous. That's one of the two. Which the other country? India. And you know what? 3 years ago, 4 years ago, ask how many institutions or companies in the United States actually had an explicit digital or an investment strategy for India. Probably very few, because we were all drinking the Kool-Aid of China. So the landscape has shifted significantly. And what that means is this landscape translates instantaneously to where you put your dollars to work. And even as a long-term investor, where you're willing to make those bets.
Right. And this translates really well to sort of the people in this room as well, who are generally heading the digital side of the house. Because one of the reasons actually that prompted this conversation was this person who's on at least 4 boards said one of the things, he's largely manufacturing companies, said one of the things they're working the hardest on is decoupling from China. They're actually setting up separate entities in China, but the rest of the world entities are being disentangled, which of course means that the ERP systems or the other systems that they have in place have now, that's a lot of work on the IT side. Like right. Chris is shaking his head, so he knows how hard that is. We spent decades integrating our global supply chains, and now we're disintegrating them. And that's a lot of hard work.
And by the way, I say all this to you not with pride that this decoupling is happening and therefore our backyard is the best. It's actually unfortunate that this geopolitical landscape has ended up in this way, and it's gotten worse. And therefore, we are having to think about alternative strategies in how we invest or develop products or services in the customers we service. It's really unfortunate.
So let's switch gears a little bit, because you do have an overall investment philosophy, the UC Investments way. Talk to us a little bit about that. Like, how do you think about sort of your investment philosophy?
Look, investing is very difficult, and obviously whether the markets are up 2.5% or 3% or down, it goes both ways in a day or in a year. You can't bank on any of those things. So I came here 8 years ago from Canada. I was imported just before the walls went up. And back then, right, the question for me was, okay, well, I've come from Canada and the Canadian pension plan is a well-known system. Then you have the Norwegian sovereign wealth funds. Then you've got David Svensson at Yale, who has the Yale endowment model. And then, of course, you have how the US pension plans operate. So the question for me personally was, who do I want to be as we invest the dollars of the University of California? And the reality is, most leaders try to say, what's the best model out there and how do I emulate that model? So I think that's probably one of the best decisions I made, is to throw away everything I knew and to stop worrying about what made me successful that got me here, but to really take stock of who's the University of California. That's why I always start the conversation with who we are. And what that made me realize is, in order to make money for Ian in the back, our dean, and for Maureen, who I was talking to, and others in the room here, I need to make sure that we are focused on the needs of the University of California. And in our case, what that means is we have a pension plan that's about $80 billion. We are the second largest defined contribution plan in the United States after the federal government, at $30 billion with 312,000 participants, voluntarily sending us $1 billion every year in our office. Then we have an endowment, then we have working capital, and we run a captive insurance business. It's not just one endowment like it is in other places. So my conclusion was, in order to improve performance, we needed to focus on doing a bunch of things. So I gathered, actually, like you're going to do tomorrow, people in the office at the time and said, what are the things we need to do to really be better at performing? Because the only thing that matters is the results. Activity is not as important if we do fewer things to get to our endpoint. And that led to 10 ideas. Number 1, less is more. Number 2, risk rules. Number 3, concentrate. Actually, let's have some fun. I left my business cards on your chairs, not because I'm trying to get lots of emails from you, but you're happy to email me as well. But can you pull that card out and flip it over? Do you see who has less is more? Anyone has less is more on the card? Excellent. Less is more. So, that's simply about doing fewer things. And so, for example, one of the things I learned was we had 340 relationships with investors around the world. Guess what happens when you're over diversified? You may do well in some investments and other investments don't do well, but you really end up paying for the index overall and expensive fees to get index returns. So we went from 340 relationships down to, we have now 16 relationships with over $1 billion each. So we really simplified our life in terms of the way we manage money. So what really the UC Investments way was all about is to try and figure out the things we need to do to improve the performance of the assets we manage. In fact, because I'm here today, I actually asked 20 of my team members to come to Dana Point tomorrow. My view is that over the next 12 months, there's only one of our 10 pillars that has to be critical for my entire team, and that's called risk rules, which is our second pillar. Who has risk rules? Excellent. So what that means is that instead of thinking about ourselves as an asset manager, which means show me your project, what's your return, how attractive does it look? I like to remind myself that I'm most importantly a risk manager, which means when you show me anything, let me understand, am I getting paid for the risks I'm taking? Because a 12% return in China is not the same as a 12% return in the United States, and it's not the same as a 12% return in the United Kingdom. And you have to decompose your risk to then figure out how you're going to make investment decisions. What I am seeing right now is excessive use of leverage by all kinds of exotic players, companies, financial actors, and people are starting to get pretty stressed about this leverage. So this is what the leverage risk that people have. What is that leading to? A lack of liquidity. Yep. Because the leverage problems lead to the fact that they need cash, they need liquidity. And if they're concentrated in certain bets, that's also another risk. By the way, you may not have seen the headlines on this, but in 2020, for a week, US Treasuries didn't trade. We're starting to see the same cracks in the Treasury markets in the last 2 weeks. That's a big deal, because payroll at the UC is $1.2 billion a month. I need to make sure our Treasuries are tradable so we can meet payroll for at least three to 4 months. So risk rules, and what I'm trying to do with my team is to impress them that the next 12 months, I just want them to focus on one thing day in and day out. Don't look for another deal. Don't come to me with another transaction, but understand where your companies or your portfolios have excessive use of leverage, how that might strain your liquidity, and what that might mean for the performance. And if we could just do that in the next 12 months, we'll probably have a good time, a better time. And it's taken me 8 years just to implement less is more in the organization. So to your question on culture, I think the thing I have learned is you can't bank on results. You know the inputs. It's people, it's knowledge, it's process, teams, and it's capital. But the dollars are green everywhere, no matter where you go. But it's the culture that you use to put all of this together that gets you the results. And that's really the UC Investments way.
Fantastic. So let me actually drill down, because I think it's funny, even though you're talking about your world of investments, when I read the whole thing and your annual report, there's a lot of parallels between what you're talking about, as there should be, right? So you talk about risk rules, and I'm going to lump that together with concentrate. So the first thing you said, in investing, what is comfortable is rarely profitable. And you said it's the same, and so I wrote, it's the same in digital transformation. It's a very uncomfortable set of investments to make. But then the second thing that you said, which I loved, was because I've heard so many companies say this over the years. You say concentrate, you quote Warren Buffett, why diversification is only required when investors do not understand what they're doing. So years ago at this conference, I won't take names, but we had a company here who this person took over as the CDO and said, the company, a very well-known company. So there's 150 strategic priorities at the job that he inherited from somebody else. And that to me also reflects a lack of true belief in where you're hedging too many bets. How do you sort of play that out in terms of these managing risk and sort of really having sort of a set of beliefs about, in your case, investments, in our case, the future of digital, the future of these companies?
Look, I personally am a minimalist, and that simply means keep your life simple. I'm a minimalist in my office. There's nothing on my desk. It feels like it's an Apple store. There's one Mac computer. And people wonder, like, is this how you're managing the assets? And everything's digital, so why not? I made a decision 8 years ago when I joined that we would spend money on digitizing all of our data and our transparency of all the assets that we owned. But here's the interesting thing. No matter how much large my portfolio gets, it still probably has less positions than all the SKUs on one shelf in Walmart. So it's not big data, it's just data that needs to be digitized, that's accessible to us and available on the cloud. And we made this investment over 7 or 8 years. But the key thing was we reduced the number of things we owned. We went down to the bare bones and the fewest things we wanted to have. That, again, that gives you concentration. Concentration is very uncomfortable, right? Look, the challenge in public institutions, and I won't say this about private institutions, is you want to do everything possible not to get fired. So if you own a lot of things and it's spread all over the place and if somebody screws up, well, it's not your fault, it's their fault, and it's small enough that it won't matter. But what do you end up doing? You end up basically creating a little bit of nothing. And then that's kind of owning the index. I mean, you might as well own the S&P 500. And so when I came here, it was a very revealing exercise. My public equities team, which is about 50% of our assets, so round numbers, let's call it $70 billion. I said, how many stocks do we own? If you aggregate all the people we've given money to and all the portfolios they own, how many stocks do we own in the public equities portfolio? They came back with the math, and the answer was like 5,000 or 6,000. I said, wow, that's more stocks than in the index. I said, how have we performed? Not even as good as the index. I said, we've given all this money away to all these managers, like 60 of them. They've bought 5,000 stocks. We've not done as good as the index, and we're paying all these fees. I'm going to be a smarter investor than all of you. Here's what we're going to do. We're going to bring all our money back home. We're going to put it in the S&P 500. We're going to close our eyes, and we're going to wake up a few years from now for 1 basis point. That's not exotic, right? It's been our best performing investment in the organization, and it's one position. So again, you have to think about results and what you own. And if you own fewer things, then you have a better sense of what you own. And the best test of this was in 2020. All of a sudden, we were told to go home for 3 weeks. It's going to be 3 years now. Now, how do you manage? In literally, you step up and you go home and you've got a portfolio then of $130 billion and you're like, turn the lights on and off you go. Well, the good news was we owned fewer things, so we knew what we owned. We had actually figured out how to get me a report every morning at 10 o'clock called the CIO's dashboard about a month prior to that happening, luckily enough. We walked into the pandemic with $32 billion of cash. And basically, we could wake up in the morning and two of us could have a conversation to say, what do? We knew what the markets were doing. And that digital platform information that we had, the transparency, because we had fewer things to understand, really gave us the confidence to actually then execute how we invested our money over the next 2 years. So less is more, and digital and fewer things and data kind of all come together in investing. But I think it's true. You can't have 150 priorities, right? If you do fewer things in life, you're more relaxed. I don't take any meetings personally till 1:30 any day of the week now. I only take meetings from 1:30 to 4:30, Tuesday, Wednesday, and Thursday in 15-minute slots. And I don't take any meetings Monday and Friday. My assistant said, are you really working? Well, my job is not chief administrative officer, it's chief investment officer. Investing is thinking and having the clarity to be able to understand when to put $3 billion in the market when you wake up in the morning. You can't do that if you're running between 2 operations or 2 meetings. It doesn't work that way. So this is religion. I mean, I'm Sikh visibly, but I'm less is more internally. That's my software, right? So that's how I invest. And it's very hard when my team comes to me and says, we're overwhelmed. My God, we got so many deals. I say, take 3 months off and come back. And they say, are you kidding? I said, no, because you don't have to do any of this stuff. Because it's not going to improve our results anyways. You just want to look like you're busy. It's all right. Come back in 3 months. You can take the time off, read the newspapers. This is how I've been able to slow us down. And slowing one down is helpful to investing as opposed to running in a marathon or a sprint every single day.
I'm still trying to figure this out. The visibly Sikh on the outside and I'm not quite sure what that contrast is there, but we'll save that for after we've had more champagne.
I spend more time figuring out the color of my turban on a daily basis than whether I should put money in the S&P 500. That's an important decision. Does that help in less
absolutely.
is more and sort of culture and putting it to work?
But you touched on digital, and one more of your principles is human meets machine, and you quote Mark Andreessen. Everybody in this audience knows this. In this audience, you are cruising along, technology changes, you have to adapt. Now, I know you've got some very active stuff going on with digital. You've got a venture capital fund with UCI Health or UCI more broadly. Right. I know you've thought a lot about digital transformation at companies. What's your thesis these days on the role of digital in the business world?
Sure. So when you're investing, and in the US, the dollars are all green. And nowadays, every dollar or every currency is digital, so bits and coins move instantaneously. You actually have no competitive advantage as an investor, for the most part. This is why the wisdom from Warren Buffett of sell everything and own the S&P 500 is not a bad philosophy. Now, same thing for us. At 150 or whatever $billion we have, we have no competitive advantages. Zero. So you might be wondering, what do we do? And I try to remind myself of that every day, that we really don't have an advantage. So we really need to be careful about what we put our dollars to work in. So out of 150, 100 billion is in the index. 50 billion, we try and do other things with. So that simplifies life. But what I have discovered about the UC Investments way is not the investing principles. It's the fact that the University of California produces 5 patents a day. We spent $5 billion a year in R&D as a UC system. How many of your companies produce 5 patents a day and spend $5 billion a year in R&D? Google, of course, and others. But the reality is we'd stack up in any competitive landscape in terms of intellectual property. That's our competitive advantage. So I discovered this coming from Canada, and I'd never even gone to school in the UC. So I'm like a kid in a candy store here, trying to figure out how do I gobble up all this stuff, right? So if I rewind the clock now 8 years, we've basically put about $1 billion to work between companies and funds that we've created captive to ourselves to invest in things coming out of the UC innovation ecosystem. And when I actually started this out in 2014 or 15, I remember the 10 chancellors convincing me we don't have enough opportunity at the UC to put $100 million to work. Every one of our campuses is contemplating potentially $100 to $200 million fund on their own. Innovation is our competitive advantage because in my backyard is Jennifer Doudna. Jennifer Doudna won the 2020 Nobel Prize for gene editing, CRISPR. In my backyard is Eric Betzik, who won the Nobel Prize for microscopy. So when I look at what is going on, again, Chad and Scott here at UC Irvine are building phenomenally amazing new state-of-the-art hospitals, physical infrastructure. But the companies that are going to come and service them with products and innovation, I mean, as Chad and Scott tell me, hospitals are basically hotel rooms with a lot of data, and they're expensive. These companies are very digital, and they're very innovative, and maybe we can own a piece of these companies. So one of our biggest competitive advantages is taking advantage of the innovation in our own ecosystem. And there are many examples of things we have done in that regard. The other competitive advantage we have is you cannot grow a university if you don't provide physical infrastructure for students to live in, which is housing. You cannot grow a university if you don't have housing for staff and faculty that's affordable. And you cannot grow a university with all these innovative, wonderful digital technology ideas or just if you don't have labs where you can tinker around with your experiments. That physical infrastructure that's required, and by the way, you can't continue to grow a $23 billion healthcare enterprise if you don't have state-of-the-art hospitals. Physical infrastructure is a competitive advantage because we have 10 campuses, 10 physical footprints where all of these things need to be built all around. Those two things, innovation and technology and physical infrastructure, surrounding the University of California or within the University of California is absolutely an edge that no one has relative to what we have at the University of California. And by the way, the president of MIT penned an op-ed in 2016 in Foreign Affairs and said, MIT is creating a lot of wonderful technology that is hard tech, and it needs an engine to incubate it and fund it and grow it, and it will take time. I called the president of MIT and I said, I'd like to come and see you. So I went to see him and I said, this is a great idea. This is after we had created our own fund to do exactly the same thing. And at the end of the meeting, I said, I'd like to invest in your fund. He goes, you can't do that because, we're kind of fighting the whole CRISPR thing, patent. I'm like, trust me. We would be the best investor for you to have because we understand what you're doing. We're doing the same thing. It took me a year to convince them. We are the second largest investor after MIT Corporation in MIT Engine, and we have been for the last 6 years. And guess what? Why did I pick MIT? Because they are the second largest patent producer in the world at 4. If I have 5 here and I've got 4 at MIT, I don't need to do a lot of other things. I can hang out in California and let all these pipeline of opportunities come. But I do need the next 30 years to mine them. We've just put $1 billion to work in the last 8 years. We're just getting started. That's the fun we can have here. And that's all digital. It's all technology. Even climate change is digital. Even agriculture is digital.
Yes.
I mean, you name it. You name a sector of this country or or California or which one of our campuses and their specialties. We have incredible opportunity. And my concentration doesn't come from diversifying by picking 10 universities. Just the University of California might sound like concentration to you, but it's the most diversified set of opportunities on planet Earth.
Yeah, I want to get to 2 more questions, and I'll turn it over to the audience for questions. I know we're at the University of California, we're very sort of focused on social responsibility. We all know what's happening with the planet and other things. How do you think about ESG investments? And
So how I used to think about ESG is very different than how I think about ESG today. Climate change has for a long time been sort of a scientific issue, scientific problem. And scientists, particularly here and at other great institutions, have said, there are alarm bells, we need to fix this. In the last 6 months, climate change has become a national security issue. Even the Green Party in Germany is willing to fire up the coal plants. It is absolutely an existential threat to humanity if you do not have electricity and energy to sustain livelihood and people's day-to-day living. That is a new critical issue that is changing my mind on how I need to think about ESG. Now, it's early days, but if you go back and if you look at the S&P 500 and you think of February 19th of 2020, that was the day the markets peaked before they troughed on the 23rd of March of 2020. From February 19th to yesterday, the energy sector has returned 91% in the S&P 500. If you rewind that clock just before the war, the tech sector had done about 48%. The last 6 months have changed the landscape. And by the way, it's not just energy now. Alongside with that comes food and commodities. And actually, if you think about renewables, the materials, the building supplies, the steel, the cement, the plastic bottles you need to actually create renewable energy is also now the blind spot, so to speak, but also a huge part of this whole fossil fuel equation. So when we think about energy today, I think we need to think about it as a national security issue, in addition to a humanity and a scientific problem that needs to get solved. That's climate change for you. So how do I think about ESG? The short answer is we will lose money this year on energy in our investments. And why is that? Because in 2018 or 19, after 5 years of working our portfolio and defossil fueling it, we actually became the first university in the country to go ex-fossil fuels, which certainly felt like an incredible accomplishment. But there will be years like 2021 and 2022 where energy will outperform even Amazon and other tech companies. And in those years, we won't look good. Now, the saving grace is we're long-term investors. I think the other saving grace is, can you imagine if I went to our students and faculty and staff and said, I'd like to go back into fossil fuels? What do you think they'd say to me? So it doesn't put a lot of pressure on me. I can keep riding this through. However, I do think you have to think about things like ammonia and urea and all kinds of these inputs that are going into our agricultural lands. I mean, there's all kinds of interconnectedness that we have to be concerned about. So ESG is not just a Texas issue or a California issue. I think it really does boil down to managing long-term risks in your portfolio and how do you earn a long-term return by balancing those risks. In 2019, it felt crystal clear that the risk of putting money in the ground to explore and exploit oil and gas was not worth it compared to the returns of earning wind and solar plants. I think in the last 6 months, some of those economics have been challenged.
Let me close with one last fun question for you. Which companies or execs do you admire?
You know what? I'm confident if I spent the chunk of tomorrow morning, which I look forward to spending with you, and I will learn a lot from each of you individually. I think I like to ask the question this way to people I meet. What is one thing you can tell me that I should learn from you and keep at the back of my mind? I always carry a little book with me, and I ask them to write one piece of advice for me. So when I look back a year from now, after a meeting I've had with them, I can see what they told me. And almost universally, the most common advice I get is learn how to be patient. And it doesn't mean much when you're younger and you're growing in your career and you want to do all kinds of cool things. But if you truly are thinking about having the humility of being at the helm of a $150 billion portfolio for a 152-year institution that will be around much longer than many of my lifetimes. Patience for future generations is the skill I try to learn, because that takes a lot of time to learn. And most leaders remind me of that in a one-to-one conversation I have with them.
Fantastic. With that, let me open it up to the floor for questions. We have runners with mics. Anybody's got questions for Jagdeep?
I'm the only one drinking the champagne. You're not.
Can you identify yourself when you ask the question?
Hi, it's Dan Stroot from Pacific Life. And I think you've already addressed some of these themes, but in some view, globalization may have peaked around 2015, and now we're in a deglobalization cycle. And you think about the countries that have experienced extraordinarily low birth rates, Japan, China, Korea, and the kind of the coming impact of their population shrinking, the decoupling of the US from China, Brexit, and the fracturing of Europe. And maybe the safe place from an investment standpoint is North America, US, Canada, Mexico, that kind of market space. How do you think about deglobalization? What does the future look like? And from an investment perspective, where do you see opportunities and where do you see risk?
So look, even before deglobalization, right, because that's super complicated to kind of get your hands on, I think the immediate opportunity is recognizing where supply chains are retracting and manufacturing is coming closer to home base, and maybe the Inflation Reduction Act is a boom for a variety of industries. So there's probably near-term opportunities in that regard. I do keep reminding myself that before the pandemic, we did have something called cancer. Immuno-oncology and immunotherapy is absolutely, revolutionary in terms of tackling cancer. I think in that context, there's stuff going on there. I think when you think about democratization or decentralization of finance, or you think about, basically empowerment of individuals versus institutions, I think Web3 has some, and blockchain has a whole variety of things attached to it that will be very interesting. I do think that, just the science of, think of mRNA, right? I mean, think of the editing that has taken place in the genes and the manufacturing of a whole new strain of things that we don't know much about, but we've pumped our bodies with. And there's more of that about to happen in solving a lot of things. I'll tell you, my dad had a bad fall 30 days ago, 45 days ago, and just one thing led to the other. It was bad, bleed in the brain, et cetera, et cetera. And 10:30 at night, second day, I texted the chief of neurosurgery at UCSF. Anyways, long story short, I came to thank him 4 days later because he literally changed the trajectory of my family. My dad lives in Canada. He was here. So I said, I'd read about the fact that he had been developing a pacemaker for the brain like a year and a half ago, which is how I randomly called him after reading about it in the New England Journal of Medicine and the New York Times. And that's how I kind of recognized I should call him. Anyways, I went to visit him to say thank you. And then I spent 4 hours with him. And he sat and walked me through how he's created a computer that basically goes into the brain, and he plugs someone into a device that can actually enable them to convert their thoughts through algorithms into speech. And it comes out on a computer. And you have to be in tears when you look at this stuff and the people that the things are changing. And I remember calling the President Drake. I had a Zoom call with him that evening, and I said, President Drake, Eddie Chang changed the trajectory of my family last night. I just want you to know that. And he said, Jagdeep, you need to understand something. What you and your team do makes it possible for Eddie to do what he does. So my job is to keep looking for the Eddie Changs of the world, and the Scotts, and the Chads at UC Irvine, and our doctors here, and all the scientists that are actually forgetting about the problems of the world and are inspired by changing the world. And I think there will be an unstoppable list of opportunities. The best companies that are in this room today happened in the 20 2000 recession. They got born in the 2000 recession. 2008 created a whole new wave of companies. I think we are at probably one of the best times. Every morning when I go to work, I ask two questions. A, I have a 9 and 14-year-old. My question is, will my 9 and 14-year-old, when I go home tonight, find this opportunity exciting? That's a serious question I ask myself. And the second question I ask is, I just joined the University of California today. I'm going to be here for the next 30 years, God willing, and I hope. Would I be making this investment with a 30-year horizon? If you ask those two questions, I spend less time worrying about deglobalization because that's a tactical shift that's taking place. What I do feel in a deglobalized world, it's better having control in your money where you can actually see it, feel it, touch it, and there's a rule of law that you understand.
Any other questions? That's-
Please.
Jagdeep, my name's Jeff Margolis, and I'm on many healthcare information technology boards of directors and a senior advisor to Blackstone and a friend of the university. So I'm curious, because I serve on so many boards and interact with so many C-suite executives, I'm curious if you have a different view than the kind of newspaper headlines on labor shortages, the leverage of employees versus employers, and the things that have sort of become pedantic over the last couple of years. Do you believe that we have a labor shortage, or do you believe that we have a productivity problem and culture change that's going to meet a reckoning as the economy normalizes to the end of 10 years of free candy money?
Tough question. I struggle with it personally as a leader. Just watching the behavior of my team members around me and their preferences. And I myself have actually gone through sort of an emotional roller coaster about working from home versus working from the office. I can't argue with productivity that we have had as a team and as an institution because of the last couple of years. I do feel, though, this is just a personal view and my own individual view, is I do think the tide will shift in the favor of the employer soon enough. I think there will be layoffs. I think there is a labor shortage. I'm seeing this. Look, there are some sectors like, we own hotels, we own a variety of things. I mean, yes, of course. And of course, if you get on planes, you see what's going on in the travel and the hospitality sector and restaurants. There clearly is a labor shortage in a lot of areas. But I do think, just mathematically, you got to balance the top line with the bottom line. And you got to look at the cost of debt in between. And I think if companies start to, you will get tech companies even for the first time laying off in a long time. Right? It's going to happen. So I think we just maybe should be patient over the next year to see if this tide shifts. I would bet on the fact that, and I have a different view even from my team members on this, I think the tide will shift a bit more in favor of the employer. Now, talent is transportable. I think there's more flexibility in terms of where you can recruit from. I interviewed somebody this morning and I'm struggling with it for 15 minutes. I met him at the airport before I got on the plane. They're in a different city, great talent. But I asked him the question, look, I commuted from Alberta to New Jersey for 100 weekends out of 104 weekends, 12 hours one way, because my mother-in-law had stage 4 lung cancer. And my wife and young daughter and son who was born were there. Reality is, you do need your toothbrush and your toothpaste in the same place to feel human. And you're not Superman or woman. The reality is, commuting is fantastic, but it wears off after a while. And I think there are going to be some new patterns that evolve after we test out these new models of working. But there's a lot more flexibility. And I think what is important is just having a mindset that is open to new models at the moment as leaders and being flexible around that. Blackstone definitely wants all their people at work, because if they don't, how do you sell more real estate, right? and so does Brookfield, and so do other people. But on the flip side, our campuses are back, our students are in the classrooms, our hospitals are functioning, our patients are now going. Why should I be privileged?
With that, thank you very much, Jagdeep, for your time and your insights.